I'm Owen Bigland. This is the Inside Edge video blog. Okay, happy Saturday. We're now into August here. Dog days of summer upon us here. Just want to do a quick blog on the state of the equity markets, the stock markets. Now, gee, as I'm doing this, my portfolio now is back up at all-time record highs. It has been an incredible 7-8 months here for 2023. I'm expecting some rough, choppy waters here like we always have. There'll be lots of pullbacks here where the Dow loses 500-600 points. But boy, if you've been an investor here like I am, an investor meaning you don't try and time markets, you buy high quality names like the Apples and the Metas and the Googles and the Johnson & Johnsons. And then also, of course, more than half of my portfolio is just in the indexes. The S&P 500, the Vanguard Dividend Appreciation Fund, the Triple Qs, the VUG. I've got a little bit of exposure to emerging markets and Euro companies, and then same thing with the Canadian market as well. It's been an incredible ride. It's funny because a lot of reading in the Wall Street Journal, so many people got this market wrong. I mean, back at Christmas time, early winter of 2023, everyone was saying the end is near. We're going into a deep recession. Sell all your stocks, put all your money on the sidelines. You'll get a way better buying opportunity next year or the year after that. And unfortunately, a lot of people listen to these guys. And even the professional money managers. Most of these guys are going to get their heads handed to them this year, like they always do. It's all a giant facade, folks. How many times I've been telling you guys about stop listening to these guys on CNBC and Bloomberg, because they're not in the business to make you money. What they're in the business of is entertainment. And entertainment is trading stock, because that's where the excitement is. Buy this, sell that, we're headed for a correction, hedge against this. It's all a giant waste of time. Just buy and hold the indexes and call it a day. It reminds me of, I've talked about this book a lot of times, The Psychology of Money by Morgan Housel. New York Times bestseller, sold over 1 million copies of this book. Everyone should read that book. But in there, he talks about know the difference between the game you're playing as an investor and the game that the guy you're listening to. Pretty much all the guys you're listening to, with the exception of a few that you see on CNBC or on Bloomberg, are entertainers. That's all they are. And, if they were to go on as a true investor onto one of these shows, like Warren Buffett often would talk about, or Jack Bogle, the late founder of Vanguard, and gave you the straight goods, which is just buy the S&P 500 or buy the Triple Q, and call it a day. That's all you need to do. Sit on your hands. As you get those dividends coming in every quarter, just keep reinvesting them. Or buy the best of the best. Do your research. Buy the Apples and the Procter & Gambles and the Home Depots and the Visas. Do your research on it. Hold these companies, reinvest the dividends, and that's all you need to do. If you did that, you would beat 80% of the active money managers cannot beat the index. And I'm starting to see more and more of these guys coming out now. Some of these professional money managers, they get near retirement or they retire and their conscience catches up to them. And a lot of them have come out recently, now that they're retired, and said, you know what, guys, probably best just to index invest. I'll be honest with you, I can't beat the indexes over long periods of time. I might get lucky once every 4 or 5 years and just eke out a slightly better return, but over 10, 15, 20, 30 years, you're going to get left in the dust trying to time a market or beat the S&P or the TSX. It's not going to happen. But, if you follow me on Twitter, and if you aren't, I've got about 2,600 followers on there, which is great considering I don't engage on Twitter at all. I'll tweet out some gems once or twice a week, 3 times a week at most, but I won't go back and forth on Twitter. I don't have the time for it. But what I do is I tweet out some articles from some people that I like to follow who I think know what they're talking about. I know they know what they're talking about. And I'll give you guys kind of some updates on kind of what I'm doing with my stock portfolio. I've got a big portfolio and I'm putting money to work pretty much every week because I've got a lot of money coming in dividends every quarter. And they come in weekly for me with the size of my portfolio. Plus I'm always putting new money to work. So I just kind of give you some ideas on what I'm buying, what I'm seeing in the market. I think if you followed followed me over the last 5 or 6 years on Twitter, you will have done pretty well, because I don't do anything fancy. I'm a simple guy. I just index invest. I buy high quality companies when they're on sale, and then I just sit on my hands. And I know there's going to be some good years, some bad years, and that's fine. I'm in this for the long run. All I care about is what it's going to be worth 10, 15, 20 years from now. And that's all you guys should care about too. And I often see, if you guys follow me on Twitter, you'll know that about a couple weeks ago I did a little tweet there on, again, kind of knowing the difference between the game you're playing as an investor and the game that a lot of these other guys, these bozos on Twitter and YouTube, are playing. I tweeted a caption from a guy who has a massive following on YouTube, like 1 million followers, this guy. He's in his early 30s. But I wanted to show people, this was a graph that I got from off of Twitter, about this guy's posts over the last year. All last year he was telling you, and they're all time-stamped, market crash is coming, sell your stocks, how to plan for the big market correction, why investing, putting your money into stocks in 2023 is going to be disastrous. So he went all the way through this for the last year and a half, and now, just last week, all of a sudden, he turns course and now capitalizing on the bull market for 2023. I just want to show people this is what these guys are all about. It has nothing to do with them giving you good advice, actionable advice, or good counsel on any of this. The reason is they don't know anything of what they're talking about. This guy has no experience as an investor. He's 24 years old. He doesn't know a thing. What he's about is about getting clicks on YouTube, and that's what you guys have to figure out. So many people are getting badly fooled here. And not just in the stock market, but in Vancouver real estate as well. There's all these same perma-bear sites that will grab you with the doomsday headline. They're not giving you good advice. The whole game there is to get clicks on YouTube and make money on YouTube. That's how this guy makes his living. He doesn't make his living as a stock investor. He's not an investor. He doesn't have the first clue of what he's talking about. His game is to get clicks on YouTube, and he's probably making $300,000 or $400,000 a year. You have to get away from those people, because for those guys, for every 10 of them, there are some quality guys on Twitter and on YouTube that are true investors. They're doing it the right way. They're buying quality companies, index investing, and they're in it for the long haul, and they're doing it right. They're not going to hit, grand slam home runs like some of these traders will often promise you. They're doing it the right way. The final thing on that is that rule of 72. I often see people on Twitter talking about, I've had a few guys comment on my portfolio saying, man, you must talk about a boring portfolio, and you're obviously not making very much money. You're not very successful. These guys don't have the first clue. What they don't understand, I tweeted out not long ago about, just buying, I put 20K straight into TD Bank. And, I've got pretty good amount of money in the Canadian banks and companies like Bell Canada and TELUS. They're boring, but they pay you a 5, 5.5, 6.5% dividend. A lot of people don't realize that if you're earning a 7% rate of return, you use that what's called that rule of 72. A 7% rate of return, I will take that all day. And with a company like Bell Canada, they're doing most of the heavy lifting from you just from the dividend. All I need is another 1 or 2% on top of that every year, and you're cooking. 7% rate of return, you will double your money every 10 years, every decade. You put $1 million into Bell Canada today, you could easily have $2 million 10 years from now. Most of that will be coming from the form of the dividend. Now, I know people are going to say, hey, oh man, but the stock can go up and down and everything else. Of course it can. In the short term, it absolutely can. It also depends on where you're buying the stock. Are you buying Bell Canada at a 52-week or an all-time high? Or are you buying Bell Canada at a 52-week or multi-year low, which is what you're buying at right now? So you don't know what the market's going to do in the short term for a company like Bell Canada, but over 10 or 15 years, hey, if I can eke out another 2 or 2% compounded annual growth, I'll take it, plus the 6.5% dividend. Take a look at the rule of 72. I'll double my money every 10 years, and I'm more than happy to do that. It's a slow and steady approach here. But stop trying to beat the market. Stop listening to these buffoons on some of these shows. there's a couple of guys, every now and again when I'm on vacation, I'll watch CNBC because I don't have cable here in Vancouver. And these guys, the last time I saw these guys was at Christmas time. They were telling you to sell your Meta shares, sell your Google. Tech is in a horrible downturn here. We're headed for a recession. Interest rates are skyrocketing. These tech companies are going to get killed. Now, have a look at Meta. You got these guys, it's up 140%. 140%. I topped up some Meta back in December, January, and February. According to a lot of people, I was a fool at that time to be doing that. But these are quality companies that you want to buy, and especially buy them when they're on sale. You see these same guys that back at Christmas time and earlier in the year were telling you to sell all those shares. Now, when I just got back from New York, I was just watching the same guys. Now we're getting back into Meta and Netflix and Google. Well, these guys, you should have been buying these back at Christmas, not now after they've had a 140% run. But that's the way these guys are. And you can dig into some of these guys on Twitter. There's a couple of guys I follow on Twitter. These guys, they're so opaque with their picks, and they're in the market, they're out. They don't really give you a whole lot of tangible advice on this. It's all very opaque. These guys have been challenged over and over by guys to reveal your returns, because they go on these shows acting like they're a guru and they're beating the markets. And they're not. It's a lie. Some of these guys have been exposed. The only way you can expose these guys is if one of their clients reveals what the returns are from these guys. And as expected, on Twitter here, they're dismal. They go on TV and they act like they're geniuses, but in reality, these guys are lagging way behind the S&P 500. And the kicker is they're charging these obscene fees to these clients for the privilege of outperforming the S&P 500. So tune all of it out, guys. We're living in an investor's dreamland right now. We really are. With access to the information we have now, with low-cost ETFs, with commission-free trading, but do it the right way. Tune out all the noise, buy high-quality companies, or just simply index invest. The longer and the more I learn about investing, the more it comes full circle just to buying the indexes and calling it a day. That's what I would suggest for most of you. I'm Owen Bigland. Have a good weekend. I'll see you guys next week.